Welcome to the deep dive. Today we're tackling something, well, absolutely fundamental to India's future, infrastructure.
Huge topic.
Right. And we're looking at it through a specific lens, a way you can potentially invest in that growth. Infrastructure investment trusts, or NVITs.
Yep, NVITs.
For this deep dive, we're focusing squarely on a major player in the, critical power transmission sector,
Yep.
PowerGrid Infrastructure Investment Trust, PGINVIT.
Okay, PGINVIT. Good one to look at.
Yeah, we've sifted through recent financials straight from the company, market analysis, articles explaining NVITs, the power sector landscape, the usual deep dive stuff.
Got the data.
Exactly. Our mission today, cut through the jargon, figure out what PGINVIT's recent performance actually tells us, understand its place in the bigger India infrastructure picture, and we'll highlight what's most important for you to know about PGINVIT and NVITs generally.
Sounds good. Let's do it.
Can these trusts really power India's future infrastructure? Okay, let's unpack this, starting with the absolute basics. What exactly is an NVIT?
Right, okay. So think of an NVIT as a specialized investment vehicle. It's set up as a trust, and it's regulated by SEBI, India's market regulator.
Right.
Its main job, its core purpose, is to pool money from different investors. Could be big institutions, could be someone like you, and then invest that cash into infrastructure assets.
Yeah.
But specifically, assets to generate income.
So not just building something, but owning something that pays.
Exactly. You could almost picture it a bit like a mutual fund, maybe. But instead of stocks or bonds, it holds tangible infrastructure. Power lines, toll roads, fiber networks, that sort of thing.
So you're essentially getting a stake in the physical assets that keep the country running, like literally owning a tiny piece of a power line.
Precisely. That's a good way to put it. And they have this very specific structure, kind of multi-layered, which is designed for governance and oversight.
Okay, layers like.
Well, first you have the sponsor. That's usually the company that originally developed or owned the assets. They're the ones setting up the NVIT in the first place.
Like PowerGrid in the case of PGINVIT.
Exactly. Then there's a trustee. Think of them as a sort of fiduciary watchdog. Their job is to oversee the NVIT's operations, make sure everything's done in the best interest of the people holding the unit holders.
Right, keeping things above board.
Yep. And finally, you've got the investment manager. They're the ones actually managing the assets day to day, and importantly, looking for potential new investments that fit the NVIT strategy.
And SEBI makes sure the original sponsor doesn't just dump the assets and run, right? There's some requirement.
That's a really crucial point, yeah. SEBI regulations say the sponsor has to hold on to a minimum of 15% of the NVIT's units for at least 3 years after they're issued.
Okay.
The idea is to make sure their interests are aligned with the other unit holders, skin in the game.
Interesting. So they can't just offload everything immediately. What kinds of infrastructure are we talking about? What can these trusts actually own, according to the rules?
SEBI has laid out a few broad categories. There's energy, that's things like power generation, transmission, which is PGINVIT's area, or distribution, then transport and logistics. That covers toll roads, highways, ports, airports, things that move people and goods.
Makes sense.
Communications is another one. Think fiber optic networks, telecom towers. Also social and commercial infrastructure, maybe convention centers or stadiums. And finally, water and sanitation projects. So it's pretty broad.
And the key difference for our discussion today, and for most people listening, is how you actually buy into these.
Exactly. You've got public listed NVITs, like PGINVIT. Their units trade on stock exchanges, just like shares. So they're accessible to retail investors, anyone with a brokerage account, basically.
Right.
Then you also have privately held NVITs. Their units are owned by a smaller group of investors, maybe institutions, and they don't trade publicly. Our focus is definitely on the listed ones today.
Okay. So for the companies building this stuff, the big infrastructure developers, why bother setting up an NVIT? What's the angle for them?
It's actually a really smart way for them to manage their capital. Think about it. Infrastructure projects cost a ton of money to build.
Yeah, huge upfront costs.
Right. So once a project is finished, operational, and starts bringing in predictable income, the developer can transfer ownership of that asset, or a part of it, into an NVIT.
And that does what for them?
It's essentially frees up the capital they had tied up in building that project. They get cash back from selling the asset to the NVIT. They can then use that cash to pay down debt, which is often substantial, or, and this is key, they can reinvest it to fund the construction of new infrastructure projects. It's called capital recycling.
Unlocking value from completed projects to fund new ones. Okay, that makes a lot of sense. Now, flip side. For us as potential investors, how do these things actually generate returns? How does the money flow to the people holding the units?
So the income comes directly from operating those infrastructure assets. If it's a power transmission InvIT, like PGINVIT, it earns transmission charges from utilities using its lines.
Like the fee PowerGrid charges state electricity board, the discoms, to move power?
Exactly that kind of thing. If it's a toll road InvIT, it earns toll revenue from vehicles. That's the top line income.
The gross revenue.
All right. Then from that gross revenue, the InvIT has to cover all its costs, operating expenses, maintenance, maybe paying interest on any debt it has, admin costs, everything associated with running those assets.
Standard business costs.
Pretty much. What's left over after all those deductions is what's called the net distributable cash flow, NDCF for short. That's the pool of actual cash available to be potentially paid out to the unit holders.
And here's where it gets really interesting. Because there's a rule about that NDCF, isn't there? Something mandatory.
This is a key feature, yes. It's why a lot of investors look at NVIs. SEBI mandates that NVITs must distribute a minimum of 90% of their net distributable cash flow to their unit holders.
90%, wow.
Yeah, it's a high percentage. It means a significant chunk of the actual cash generated by the underlying assets is required by law to flow back to the investors.
And that money arrives in what form? Like, how does it land in your account?
It's typically distributed as a combination of dividends and interest payments. And this usually happens quite regularly, often quarterly or maybe half-yearly.
Okay, regular payouts. Now, the crucial question for anyone thinking about this, taxes. How is that income treated?
Right, always important. So both the dividend income and the interest income you receive from an NVIT are generally taxable based on your individual income tax slab rate.
So it just gets added to your total income for the year?
Pretty much, yeah. Now, if you sell your NVIT units, that's a different story. That's capital gains tax.
Okay.
If you sell within 3 years of buying, it's considered a short-term capital gain, STCG, and that's taxed at 15%. If you hold the units for more than 3 years, it becomes a long-term capital gain, LTCG, and that's taxed at 10%, but only on the profit above 1 lakh in a financial year.
Got it. So considering that structure, the income potential, the tax side, why might someone consider adding NVITs to their investment mix based on what the sources are saying? What are the upsides?
Well, the sources we looked at highlight a few key potential benefits. First off, diversification. Infrastructure as an asset class tends to behave a bit differently from your usual stocks or even corporate bonds.
So it doesn't necessarily go up or down at the same time.
Exactly. Adding NVITs could help spread your risk and maybe smooth out the bumps in your overall portfolio, reduce volatility potentially.
And that mandatory distribution rule you mentioned, that points directly to income potential, right?
Absolutely. That requirement to distribute at least 90% of the NDCF offers the potential for regular income. If you're an investor looking for somewhat predictable periodic cash flows, that's a big draw for NVITs.
Yeah, you can see the appeal there. And it feels like a very direct way to connect your investment to the broader economic story.
It really is. It gives you direct exposure to India's growth story. You're essentially investing in the physical backbone that makes economic expansion possible. The power lines fueling factories and homes, the roads carrying goods, the networks keeping everyone connected.
All right, that gives us a solid foundation on NVITs generally. Let's zoom in now on our main subject, PowerGrid InvIT, or PGINVIT. What's the story here? What makes this one stand out?
Okay, PGINVIT. Well, its sponsor is the PowerGrid Corporation of India Ltd. That's a huge name, a Government of India enterprise, a Maharatna company. So it has very strong backing.
And it made history because of that government connection, didn't it?
It did, yeah. PGINVIT was actually the first time a state-owned company in India monetized its assets using an InvIT structure and then listed it publicly on the stock exchanges.
Wow, the first PSU InvIT.
Exactly. Its IPO was back in April 2021. The price band was 99 to 100 per unit. That was a pretty significant move, allowing the public to directly invest in assets that were previously entirely government-owned.
So what specific assets are we talking about inside PGINVIT? What does it actually own?
Its focus is purely on owning, operating, and maintaining high-voltage power transmission assets across India. When it launched, it initially acquired a 74% stake in 5 specific transmission projects. These are structured as separate companies, SPVs, or special purpose vehicles. You might see names like PVTL, PKTL, PPTL, PWTL, and PJTL in the reports.
Okay, so it owns most of these project companies.
Right, 74% initially. And importantly, PowerGrid itself, the sponsor, is still responsible for the actual operation and maintenance, the O&M, of these transmission lines under specific agreements.
So PowerGrid runs them, PGINVIT owns them, essentially.
That's a good simplification, yeah. And the latest checks, according to one source, confirm they're all up and running. Yes, the source mentioned that virtual inspections were done as recently as September 2024, and they confirmed that all the assets currently held by PGINVIT are fully operational and performing as expected.
Good to know. Okay, let's get into the numbers then. We've got the unaudited financial results for the quarter and the 9 months ending December 31st, 2024. What do these figures tell us about how PGINVIT has been doing lately?
All right, looking at the consolidated numbers, that means including the underlying project companies. For the quarter ending December 31, 2024, the total income came in at 11,743.06 crore.
How does that compare?
It's actually a slight dip compared to the same quarter the previous year, which was 11,819.70 crore. So down a little bit quarter on quarter.
Okay. What about the longer view, the 9 months?
Over the 9-month period ending December 31, 2024, the consolidated total income was 34,868.58 crore. That's actually a marginal increase compared to the 34,607.73 crore in the same 9 months last year.
Huh. So a mixed picture, down slightly in the last quarter, but up slightly over the 9 months. What about expenses? Did they follow the same pattern?
Pretty much, yeah. Total expenses for the quarter were also down slightly to 6,828.65 crore from 7,076.49 crore year on year. But over the 9 months, expenses were largely stable, 20,781.31 crore this period versus 20,742.0 crore last year. Very little change there.
And the bottom line, the profit after tax.
Okay, the consolidated profit after tax for the quarter was 3,861.63 crore. That's down a bit from 4,268.25 crore in the same quarter of FY24.
And for the 9 months?
The 9-month consolidated profit also saw a small decrease, landing at 11,378.57 crore compared to 11,406.83 crore the previous year.
So, overall, profits are down slightly both for the quarter and the 9-month period compared to last year. Any specific reason mentioned for that slight dip? Transmission income is usually pretty stable, isn't it?
That's true. It generally is quite stable because it's based on regulated tariffs. The sources don't explicitly pinpoint one single reason for the slight profit dip. It could be minor variations in operating costs, maybe timing differences in when expenses were booked, or perhaps regulated tariff increases didn't fully offset some costs in that specific period.
Okay.
It's worth remembering these are unaudited results too, so final figures could change a bit. But the big picture seems to be one of relative stability. Definitely not a major downturn, just small fluctuations.
Fair enough. The reports also break down where the money comes from, right? By segment.
Yes. Unsurprisingly, the vast majority comes from their core transmission segment. That's the main business.
Makes sense.
There were also contributions reported from telecom and consultancy segments. However, there's a note in the financials saying that the telecom business subsidiary was actually transferred out. So its results are now reported under discontinued operations.
Ah, okay. So going forward, it'll be even more focused on just transmission revenue.
That seems likely, yes. The performance will be even more closely tied to those core power transmission assets.
And there was something about a regulatory impact mentioned, a CERC order.
Yes, that's a key detail.
Yeah.
There was a final order from CERC, that's the Central Electricity Regulatory Commission, dated March 15, 2024. This order related to transmission tariffs, but specifically for the period from 2024 to 2029.
Okay.
Now, because of this order, PGINVIT's reported transmission income for this quarter and 9-month period actually included some extra amounts, basically, retrospective increases related to earlier years. It was about 63 crore extra for the quarter and around 363 crore extra for the 9 months, all pertaining to periods before the current reporting one.
Interesting. So even though the headline profit dipped slightly, they actually got a boost from this regulatory decision applying to past periods.
Exactly. It highlights how these regulatory decisions can swing the reported numbers, sometimes looking back several years. It adds a layer of complexity to just reading the headline figures.
Definitely something to keep in mind. Okay, let's talk about the distributions, the payouts to unit holders. That's the main attraction for many. How's PGINVIT doing there?
They seem quite consistent with distributions.
Yeah.
The board declared an interim dividend that's like a mid-year payout of 4.50 per unit for the financial year 2024-25. That was declared on November 6, 2024, and paid out in early December.
4.50 per unit. How does that compare to before?
Well, the reports mentioned that this followed a previous dividend of 3.25 per unit.
Yeah.
So this latest interim dividend is notably higher, which could suggest a potentially higher total payout for the current financial year, assuming cash flows support it.
Okay, that's positive for income seekers. What about other key financial metrics? Things like market cap, unit price, book value. What ranges are we seeing in the sources?
Right. These numbers fluctuate, of course, depending on when the source pulled the data.
Hmm?
But the market cap is generally reported somewhere between roughly 7,500 crore and maybe 8,500 crore.
Okay.
The unit price seems to be hovering in the low to mid 80s.
Yeah.
Let's say 82.9 to 85 in the reports we saw. And the book value per unit is cited in a very similar range, around 83 to 85. So the market price has been trading quite close to the book value recently.
And the DPU distribution per unit figures.
Yeah, different figures pop up depending on the period being referenced. One source mentioned 3 for Q2 of that fiscal year. And then we have the 4.50 interim dividend for FY25 that was just declared. So you see different numbers depending on the time frame.
Right, and I noticed something really striking. The reported dividend yields in the sources varied massively, like from about 3.2% up to over 18%. How can it be such a huge range? That 18% seems high.
Yeah, that's a great point, and really highlights why you need to be careful with just looking at a yield percentage. Dividend yield is calculated basically by taking the annualized distribution and dividing it by the current unit price.
Okay.
That huge range you saw likely comes from a few things. Different sources might be annualizing different payout periods, like are they annualizing just the latest quarterly payout, or are they using the total distributions from the previous full year? Also, the unit price used in the calculation could be from different dates, and prices fluctuate.
So the denominator changes and the numerator assumption changes.
Exactly, that 18% figure. It seems unusually high. It might be based on annualizing a single, perhaps larger than usual distribution, or maybe calculated when the unit price was particularly low. It's probably not reflective of a sustainable, ongoing yield expectation.
So the takeaway is,
Look at the consistency and the source of the distributions. Is it coming from stable net distributable cash flow? Rather than getting fixated on a single, potentially misleading yield figure calculated at one specific point in time. Understand how the yield was calculated.
makes sense. Look deeper than the headline number. What about debt? Are they leveraged up using borrowed money?
This is actually a really notable characteristic of PGINVIT. Based on the sources, they seem to have a very, very conservative approach to debt.
Oh, really? How low?
Extremely low. The reported debt-to-equity ratio is tiny, around 0.07, and another metric, net debt relative to the assets under management, AUM, was also very low, reported around 1.22% as of September 30, 2023.
Wow. And SEBI allows them to take on much more debt than that, doesn't it? Especially with a strong sponsor like PowerGrid.
Oh, absolutely. For NVITs that have a top credit rating like AAA, SEBI regulations actually permit consolidated leverage total debt up to 70% of the net asset value. 70%.
And PGINVIT is at what, just over 1%?
Right, so they are miles below that regulatory ceiling. This points to a very conservative capital structure. But critically, it also means they have a huge amount of headroom to potentially take on debt in the future if they decide to fund acquisitions or growth projects.
It's a lot of dry powder, potentially.
It is, and their ability to service debt looks strong too. The interest coverage ratio, which measures how easily they can cover interest payments with earnings, reportedly improved significantly to 24.4 times in FY24. Very healthy.
So if they're not using much debt right now, how does PGINVIT plan to grow? How can they increase those distributions over time? What's the strategy outlined in the sources?
Well, there's one very clear near-term growth driver mentioned quite explicitly. That's the plan to acquire the remaining stakes in 4 of those initial project companies, the SPVs, PWTL, PPTL, PJTL, and PKATL.
Ah, the ones where they initially bought 74%.
Exactly. The plan, expected to be completed by the end of FY 2024, is to buy the remaining 26% stake from PowerGrid.
And that directly boosts their income.
Yes, because once they own 100%, PGINVIT will receive all the distributable cash flow from those projects instead of just 74%. That should directly increase their overall NDCF and therefore the potential payouts to unit holders. It's a pretty straightforward way to grow cash flow from the existing asset base.
Okay, that makes sense. What about adding completely new assets to the portfolio?
Yes, there's some mention of implementing new assets, like a specific project involving a 400 kV bus reactor at a substation.
Mm,
Small additions. But a potentially much larger source of future growth is tied to the government's big national monetization pipeline, the NMP.
right, the NMP. How does that fit in with PGNVIT's growth plans?
So the NMP is this government initiative aimed at unlocking value from existing operational assets owned by public sector entities. The idea is to get private participation or monetize these assets and use the proceeds to fund new infrastructure.
And PowerGrid owns a lot of transmission assets.
A huge amount. As the owner of these assets, PowerGrid is expected to offer more of its operational transmission projects for monetization under this NMP framework. And PGINVIT, being the InvIT sponsored by PowerGrid, is seen as the natural logical buyer for these assets when they come up for sale.
Okay, so PowerGrid could potentially sell more transmission lines directly to PGNVIT in the future, growing the InvIT's asset base.
Precisely. This is viewed as a major potential growth avenue for PGINVIT down the line. However, there's a caveat mentioned in one source.
Which is?
The timing and the specific assets that PowerGrid might actually offer under the NMP are, well, uncertain. It depends on the government's and PowerGrid's own timelines and priorities. So while the potential is there, this growth path is maybe less predictable than, say, buying the remaining stakes in the current projects.
Got it. Potential but uncertain timing. And this actually brings up an interesting comparison that one of the sources made contrasting PGINVIT's growth approach with another InvIT, like IndyGrid.
Right. That source drew a distinction. It portrayed PGINVIT's growth as being perhaps largely dependent on these asset transfers coming from sponsor PowerGrid, whereas IndyGrid was described as being potentially more proactive, maybe more aggressive, in seeking out growth opportunities from various sources, even exploring different asset types like solar generation assets alongside transmission.
So it raises a question about different growth philosophies.
Exactly. It makes you think about the long-term growth momentum. Is PGINVIT's growth potentially capped or limited by its reliance on PowerGrid's divestment schedule? Or is that sponsor relationship a unique strength? It contrasts with a strategy of actively hunting for assets across the wider market. It highlights that not all InvITs necessarily follow the same growth playbook.
That's a really important nuance, the sponsor relationship as both a strength and potentially a constraint on independent growth strategy. Okay, let's talk risks. No investment is risk-free. What are the challenges facing PGINVIT specifically, and maybe the broader power transmission sector, according to the sources?
Definitely. For PGINVIT itself, several risks are flagged. One is market dependence. If they need to raise money to buy new assets, they might issue new units. Doing that successfully depends on market conditions and investor appetite at that time.
So if markets are down, raising capital gets harder or more expensive.
Right. Then there's the flip side of that mandatory distribution rule. While it's great for income investors, having to pay out 90% of cash flow can limit the capital available for reinvestment in growth or major upgrades unless they keep raising external funds, either debt or equity.
Makes sense. And for assets like power lines, regulation must be a big factor.
Huge. Regulatory risks are always present. Changes in tariff rules by the CERC or other government policies affecting the power sector could directly impact PGINVIT's revenues and profitability.
Okay, what else?
The sources also mention ongoing litigation and disputes, things related to land acquisition compensation, crop damages during construction, even disputes over the routing of transmission lines, plus some tax disputes. These create uncertainty and could lead to potential financial liabilities down the road.
Right, legal battles can drag on.
And then there's what you might call sponsor risk. While having PowerGrid as a sponsor is generally seen as a major strength due to their expertise and stability. Well, hypothetically, if PowerGrid's own operational efficiency or financial health were to deteriorate significantly for some reason, it could potentially affect the quality of the operation and maintenance services they provide for PGINVIT's assets. Although the InvIT structure does usually allow for replacing the O&M provider if necessary.
Okay, a theoretical risk, but tied to the sponsor's health.
And finally, just broad economic downturn risk. While electricity transmission demand is generally considered less cyclical than many other sectors, people always need power. A major economic slowdown could potentially reduce overall electricity demand growth, which might indirectly affect revenues or future regulatory decisions.
Got it. Those are risks more specific to PGINVIT. What about the whole power grid sector? The sources mentioned broader challenges too, right?
Yes, and these are really significant for the whole country. A massive challenge is integrating the growing amount of renewable energy. Solar and wind power are great, but they're intermittent. The sun doesn't always shine, the wind doesn't always blow. That variability creates instability that the grid has to manage, which is technically complex.
Yeah, balancing a grid with fluctuating inputs sounds tricky.
It is. Then there's the issue of frequent power outages in some areas, sometimes caused by extreme weather events, which seem to be increasing, or simply due to aging infrastructure needing upgrades.
Still a reality in many places.
The grid also needs to cope with increased demand from electromobility. Think about millions of electric vehicles potentially charging at the same time. That creates huge new load patterns the grid wasn't originally designed for.
The EV surge is a big one.
Definitely. All this points to a massive need for grid modernization, making the grid smarter, more resilient, more flexible using new technologies. And finally, as the grid becomes more digital and interconnected, the threat of cyber attacks on this critical infrastructure becomes a much more serious concern.
Wow. So PGINVIT is operating right in the middle of a sector that's undergoing some really profound, complex changes and facing huge technological and operational hurdles. How do NVITs and PGINVIT within that fit into the bigger picture of India's massive infrastructure plans?
They're actually a really crucial piece of that puzzle. India's economy has shown strong growth fundamentals, and building out infrastructure is absolutely key to sustaining that. The government has these huge initiatives like the National Infrastructure Pipeline, NIP.
That's the one with the massive investment target.
Yeah, aiming for something like 111 trillion, that's trillion with a T, in infrastructure investment by FY25. And a very significant chunk of that, over 20%, is specifically earmarked for the power sector.
Okay, huge focus on power.
And the National Monetization Pipeline, NMP, we talked about earlier, fits right in. It's the strategy to help fund some of that NIP investment by unlocking capital from existing operational public assets. NVITs provide the regulated market-based vehicle to actually do that monetization efficiently.
So NVITs help recycle capital for the NIP. And this is all happening while India is also pursuing ambitious climate goals.
Exactly. You've got India's Panchamrit's climate commitments, big targets like reaching 500 gigawatts of non-fossil fuel energy capacity and meeting 50% of energy needs from renewables by 2030.
Ambitious targets.
Very. And achieving those fundamentally requires a massive expansion and modernization of the power transmission grid. You need stronger, smarter grids to transport renewable energy, often generated far from demand centers, across the country reliably. Think about the One Nation, One Grid, One Frequency achievement that itself was a result of huge past investment in transmission.
So NVITs are financing the very infrastructure needed for the energy transition.
Precisely. NVITs like PGINVIT are playing a direct, critical role by providing a financing mechanism to help build, upgrade, and maintain this expanded, more intelligent grid that's essential for both climate goals and continued economic growth.
That really puts their role in perspective. Now, just to add a bit more context, the sources briefly compared PGINVIT with another one, IRB InVIT. What did that comparison highlight?
Yeah, it was a useful contrast mainly to show the diversity within the NVIT space itself. IRB InVIT, for instance, is focused on toll roads, so that's transport infrastructure. PGINVIT, as we know, is in power transmission energy infrastructure.
Different sectors entirely.
Right. They both offer investors exposure to vital parts of India's infrastructure story, but they operate in completely different segments. They'll have different demand drivers, different regulatory landscapes, different operational challenges.
And their financial profiles look different too, based on the snapshot provided.
Yes. For the periods reported in that comparison, IRB InVIT apparently showed strong growth in toll revenue, which can be sensitive to economic activity and traffic volumes. PGINVIT, meanwhile, was characterized by its stable transmission income, with growth more linked to acquiring new assets or stakes.
And their debt levels.
Also quite different, highlighting varying strategies. IRB InVIT was mentioned as having a higher net debt-to-asset ratio, around 22%, whereas PGINVIT, as we discussed, had that very low net debt-to-AUM of about 1.22%. This reflects potentially different approaches to using leverage and maybe different risk appetites or stages of growth.
So the takeaway is, even though they're both NVITs, you really need to look at the specific trust, the sector it's in, and its individual strategy.
Absolutely. It just reinforces that NVIT is an umbrella term. The underlying business and the management strategy matter hugely.
All right, that's been a really thorough exploration. We've covered what NVITs are, these specialized trusts for infrastructure investment. We looked at their structure, how they aim to generate returns, especially through that mandatory distribution, and the potential benefits like diversification and income.
Yeah, the basics are important.
Then we did a deep dive specifically into PowerGrid InvIT. We examined its recent financials showing overall stability, but with some slight variations in regulatory impacts. We looked at its growth strategy, which seems heavily focused on acquiring the remaining stakes in its initial assets and potentially benefiting from future asset sales under the national monetization pipeline.
And the conservative debt structure.
Right, that very low leverage. We also discussed the significant risks, market dependence, regulatory changes, sponsor reliance, and the huge broader challenges facing the power grid sector, like integrating renewables and meeting EV demand.
Big challenges, definitely.
So it's clear that NVITs, and PGINVIT as a prime example, offer a distinct way for you, the investor, to participate directly in building India's crucial infrastructure and potentially earn regular income. But, like any investment, it absolutely comes with its own set of risks and requires careful understanding of the specific trust, its assets, the sector dynamics. What really stands out to you from all this? For me, this raises a really important question.
Yeah, what comes to my mind is this. Think about the sheer scale of transformation needed for India's power grid. We're talking about rapidly integrating massive amounts of variable, renewable energy, handling huge new demand surges from electric vehicles, industry, connecting everything reliably, making it smarter, more resilient.
It's not just building more lines, it's fundamentally changing the grid.
Exactly. It's a technological and financial challenge of immense proportions. Now, looking at the current structure of NDITs, particularly PGINVIT with its, let's say, reliance on sponsor-driven asset transfers and its currently very low use of debt, is this model, as it stands today, truly sufficient to finance the pace and complexity of grid transformation required in the coming decade or two? Or will we need new funding mechanisms, maybe more aggressive capital raising strategies from the NDITs themselves, or entirely different approaches to bridge that massive investment gap for the grid of the future?
Welcome to the deep dive. Today we're tackling something, well, absolutely fundamental to India's future: infrastructure.
Huge topic.
Right. And we're looking at it through a specific lens, a way you can potentially invest in that growth. Infrastructure investment trusts, or NVITs.
Yep, NVITs.
For this deep dive, we're focusing squarely on a major player in the, critical power transmission sector,
Yeah.